Hello everyone, and welcome back to Accounting Insights with Rula. Today we're diving into one of the most important yet often overlooked steps in the accounting cycle, closing entries. You might be wondering, why do we need to close accounts at all? Well, imagine you're wrapping up a long financial journey that lasted an entire year. Before you start the new one, you need to reset your books to give every income and expense account a fresh start. That's exactly what closing entries do. They help us transfer the results of our hard work, the net income or net loss, into the owner's capital account, clearing the way for a brand new fiscal year. So in today's session, we'll explore what closing entries are, why they're essential in preparing accurate financial statements, and how to record them step by step. Ready to close the books with confidence? Let's begin. Before we move to our example, let's first summarize the general rule for preparing closing entries. Closing entries are completed at the end of the accounting period to transfer the balances of temporary accounts, such as revenues, expenses, and drawings, to the owner's capital account. This process ensures that these temporary accounts begin the new fiscal year with zero balances, allowing us to measure income and expenses accurately for the next period. Now that we've established the rule of closing entries, let's look at the sequence we follow to prepare them. First, we begin by closing all revenue accounts to the income summary account. This step transfers the total revenues earned during the period into one summary account, preparing us to match them against expenses. Second, we close all expense accounts to the income summary account. This step gathers all the expenses in one place, allowing us to determine the net result of operations, whether the business earned a profit or incurred a loss. Third, we transfer the balance of the income summary to the capital account. The balance at this stage represents either net income or net loss, which must be added to or deducted from the owner's equity. And finally, we close the drawing account to the capital account as well to record the owner's withdrawals and adjust the final capital balance. Once these four steps are completed, all temporary accounts will have zero balances, and the owner's capital account will reflect the results of the period, the true financial position at year-end. Now, let's apply this rule to the trial balance of Rula Consulting Services and see how each entry is prepared step by step. Now, let's see how these ideas apply in a real accounting scenario. Here we have the trial balance of Rula Consulting Services as of December 31st, 2024. Now at this point, the company has completed all the necessary adjusting entries and prepared its financial statements. The next step is to close the books, in other words, to prepare the closing entries that will reset all temporary accounts for the new fiscal year. Notice that the trial balance includes the revenue account, several expense accounts, and a drawing account. These are all temporary accounts, meaning their balances should not carry over into the next period. Instead, we transfer their balances to a summary account known as the income summary, and then ultimately to the owner's capital account. Now that we've reviewed the example and understand the process, let's put it into practice. We'll go step by step and prepare the closing entries for Rula Consulting Services together. Now let's begin with the first step, closing the revenue account. In our case, we have just one revenue account, service revenue. To close it, we need to transfer its entire balance to the income summary account. As you can see, we debit service revenue for 3,800 Jordanian dinars, bringing its balance down to zero, and credit income summary for the same amount. If we look at the T accounts below, the service revenue account now shows a closing entry of 3,800 Jordanian dinars on the debit side, which clears it out completely. Meanwhile, the income summary account records 3,800 Jordanian dinars on the credit side. That's the revenue now carried over for the period's summary of results. Now that we've transferred the revenue to the income summary, it's time to turn our attention to the expenses. Just as we closed revenue to the income summary, we'll now close all expense accounts, including rent expense, salary expense, and utilities expense to the same account. Each expense will be cleared from the books and transferred to the income summary, allowing us to determine the business's overall performance for the period. Let's move to the next step and see how this process is recorded. Building on what we just completed with the revenue accounts, we now shift our focus to the expense accounts. Since expense accounts normally carry debit balances and reduce owner's equity, we close them by recording credits that bring each expense balance to zero. In our example, we have three expenses: rent expense, salaries expense, and utilities expense, which together totaling 1,900 Jordanian dinars. So we record that total in the income summary account by debiting income summary for 1,900 Jordanian dinars. This action moves the period's total expenses into the income summary, where they will be compared with revenues to determine net income. Now look at the T accounts below. Each expense T account shows a closing credit that reduces its balance to zero, readying those accounts for the next accounting period. The income summary T account now displays both sides of performance: 3,800 Jordanian dinars revenues on the credit side and 1,900 Jordanian dinars expenses on the debit side. The difference between those amounts represents the net result of operations, which we will finalize in the next step when we close income summary to capital. And now we are ready to complete the process by transferring that net income to the owner's capital account. So let's look at our third closing entry, close income summary to capital. Here we debit the income summary for 1,900 Jordanian dinars to bring its balance to zero, and we credit Rula capital for the same amount. This increases the owner's equity by the net income earned during the year. If we look at the T accounts below, you'll notice that the income summary account is now closed. Both sides are equal and the capital account has increased from 7,000 Jordanian dinars to 8,900 Jordanian dinars after adding the 1,900 Jordanian dinars of net income. This step officially transfers the company's profit to the owner's capital, reflecting the business's performance for the year. And now we will complete the closing process with the final entry, transferring the balance from the drawing account to the capital account. The drawing account represents the owner's withdrawals during the year and typically carries a debit balance. To eliminate this balance, we credit the drawing account and debit the owner's capital account, effectively reducing the owner's equity by the amount withdrawn. Specifically, we will debit Rula capital for 500 Jordanian dinars and credit Rula drawing for the same amount. When we examine the T accounts, we can see that the drawing account is now at zero, while the capital account decreases from 8,900 Jordanian dinars to 8,400 Jordanian dinars. This change reflects both the net income added earlier and the owner's withdrawals throughout the year. With this entry, all temporary accounts are closed and the owner's equity on the balance sheet now accurately reflects the final year-end balance. Now that we have closed all temporary accounts, let's step back and review our progress. We will walk through each step together to clearly see how revenues, expenses, and drawings flow into the owner's capital. Let's take a moment to review the entire closing process using the following steps. We started by closing the service revenue account and transferring 3,800 Jordanian dinars to the income summary. Next, we closed all expense accounts: rent expense, salaries expense, and supplies expense, resulting in a total of 1,900 Jordanian dinars moved to the income summary. At this point, the income summary reflected a net income of 1,900 Jordanian dinars, which we then transferred to Rula's capital account. This action increased the owner's equity for the year. And finally, we closed the drawing account by transferring 500 Jordanian dinars from Rula's capital to Rula's drawing, which indicates the owner's withdrawals during the period. After completing these steps, all temporary accounts now have zero balances, and the capital account displays a final year balance of 8,400 Jordanian dinars, preparing it for the next accounting period. We've now completed the closing process, the final step in preparing our accounts for a fresh start in the new accounting cycle. I hope this lesson helped you connect the dots and see how each step contributes to the overall accounting cycle. Thank you for being part of today's session. Until we meet again, take care and keep moving forward with confidence. Goodbye.